Pick up your phone and open Amazon, Flipkart, or Myntra. You can see a button whispering "Pay later" in easy EMIs. It feels harmless and smart. Now let's take a moment and rewind to a parent's generation. They saved 2 years to buy a fridge. You bought yours in 90 seconds. This single shift, that one button, is quietly rewriting the entire Indian economy.
India's household debt has risen to over 41% of the country's GDP as of March 2025.
And today, we are diving into this debt bomb inside 300 million Indian households. For decades, the Indian household had one identity in the global economy. We were savers, stubborn, disciplined, and obsessive savers. Economists wrote PhDs on us. Foreign banks envied us. That was our Indian superpower. But here is a headline that most people missed in the last quarter. India's total household debt has now crossed 41% of our GDP.
India's household debt has climbed to 41.3% of the GDP as of end of March 2025, up from a 5-year average of about 38%.
And while that number alone is not catastrophic, the speed at which we got here is unbelievable. This is what is keeping the RBI governors awake at night. And let me tell you this, when the central bank stops talking about growth and talks about risk, you should pay attention. Here is a data that should be on every Indian newspaper's front page. India's net financial savings has collapsed to 5.3% of our GDP, a multi-decade low. For every 100 rupees the Indian household earns, they are now saving less than 6 rupees in real financial assets. The rest is being spent or goes away into an EMI gateway. Now here's a $1 million question. What are we borrowing for?
That Indian households are borrowing more, but what is concerning is what that borrowing is for.
Because not all debt is created equal. A home loan builds an asset. A student loan builds a career. Economists calls this good debt. So what is exploding in India right now? Nearly 55% of all household debt is non-housing retail loans, personal loans, credit card balances, pay later schemes, loans for Goa trip, for iPhone, the list goes on and on. This is consumption debt. That means debt for things that lose value the moment you swipe, unlike the education loan and the housing loan. And here's the part that should genuinely scare you. The credit card in India now carries an interest rate of around 30 to 40% annually. And I'm sure you never knew it. Let me repeat that for you, 40%. This is not a loan, this is financial quicksand. Miss one payment and the math turns against you. It is faster than you can earn your way out. Now let's flip the lens, because blaming the consumer is too easy. This is not a story of personal weakness. This is three forces shooting you at once. Number one, the stagnant incomes. Real wages in urban India have barely moved in the last 5 years. But on the other hand, school fees, rent, and groceries have nearly doubled. Debt is no longer a luxury for many Indians. It is a bridge between the 1st and the 30th of every month. Number two, frictionless credit. 20 years ago, getting a personal loan meant many visits to the branch. In addition, we need to find out 2 guarantors and a week of confusing paperwork. Today, it's too easy. Think about it. Just 3 taps, no documents required, and money is in your bank account before you finish your coffee. Now here's number 3, the so-called silent emergencies. A hospital bill, a college admission. For a growing slice of Indian families, debt is not a choice, it is a survival mantra. And this is exactly where the Reserve Bank of India is stepping in. In 2023, RBI pulled out what is called the risk weight lever. In plain language, RBI made it expensive for the banks to hand out unsecured loans, a direct surgical signal to the system saying, slow down. And it really worked. Unsecured loan growth cooled by mid-2024. Then in early 2025, the RBI partially rolled back that move, but only for loans flowing to the NBFCs or non-banking financial companies. The central bank is not slamming the brakes. So where does this leave us? The answer is understanding 3 rules carefully. Number 1, know the difference between good debt and bad debt. A loan that builds an asset or a skill is an investment. A loan for something that loses value is a tax on your future self. And number 2, track your EMI to income ratio. If more than 40% of your monthly income is going to repayments, you're not living a lifestyle, you're serving one. Point number 3, build an emergency fund before anything else. 6 months of expenses in cash reserves. That single buffer is the cheapest insurance against a 40% credit card spiral. Because here is the truth nobody will tell you. Your next EMI is not just a personal decision, it is a vote for what kind of economy India becomes over the next decade. So are we building a confident, dynamic consumer economy, or are we fueling a growth story that one bad quarter could crack? The choice is genuinely in your hands. We are a brand new channel and we are trying to build a community that understands the intersections of business and geopolitics. If you found value in this video or if you have learned something new, please consider subscribing. Thanks for watching and I'll see you in the next one.